Breaking news, and I mean real breaking news, because while most people were asleep, silver didn't just move, it lunged. We're staring at roughly $95 an ounce, and the week is barely underway. And if you're thinking, I've heard this before, stay with me, because the next few minutes are about connecting dots most people never even think to look at. This isn't just about whether silver can tag 100. The real question is, what happens to everything else when it does? Premiums, availability, those so-called deals, the way governments start talking about strategic metals, and the way big money quietly repositions once panic makes the headlines. I'm also going to walk you through why this move is not the same as the fake-out rallies you've seen before. Let's step into it. Silver hovering around 95 isn't just a number, it's a threshold. This is the level where markets stop whispering and start shouting. It's the kind of move that forces even the silver is boring crowd to sit up and say, wait, what? We're talking about roughly a 5% move on the day. And while silver is grabbing attention, gold isn't sitting still either. It's pushing higher, printing fresh highs, and reminding everyone that the entire precious metals complex is moving together. But here's where it gets interesting. The real headline isn't silver at 95. It's the ratio. The gold to silver ratio has dropped below 50. Let that sink in. For the first time in roughly 15 years, it now takes fewer than 50 ounces of silver to trade for 1 ounce of gold. That's not trivia. That's a structural shift. It forces uncomfortable questions for portfolio managers, traders, and everyday people alike. If the ratio keeps compressing, do you rotate, do you rebalance, or do you wait for the next shock? Now here's another signal quietly flashing red. International pricing. On a pure spot comparison, silver is trading at a noticeable premium overseas. On at least one major Asian exchange, pricing has pushed into the low 100s per ounce, several dollars above Western benchmarks. That kind of gap isn't noise, it's physical demand willing to pay up. And this is the part nobody likes to say out loud. Once buyers get comfortable paying premiums at these levels, the idea of cheap silver disappears. It's no longer about what you can find today. It's about what price becomes normal in people's minds tomorrow. Before we go further, here's how to frame what's happening. There are 3 forces driving this move. Then, there are 2 signals that will tell us whether 100 is a ceiling or just a speed bump. And after that, there's a wild card that could flip the entire table. Force number 1 is fear. Geopolitical tension, trade disputes, and rolling headlines are pushing capital toward perceived safe havens. Call it uncertainty. Call it risk-off. Call it fatigue from constant surprises. The label doesn't matter. The behavior does. Money runs toward what it believes will survive the storm. You've seen the headlines. Contested resource regions, shipping routes under pressure, tariffs being floated again. You don't need to pick a political side to understand the outcome. Markets hate uncertainty. And when uncertainty spikes, metals benefit. Force number 2 is monetary reality. People are waking up to the fact that high interest rates on paper don't necessarily translate into real purchasing power. If inflation is eroding cash faster than savings grow, you're losing ground while being told you're being paid. That realization pushes capital toward hard assets. Force number 3 is utility. Silver isn't just something you stack. It's an industrial metal embedded in a world racing to electrify, digitize, and militarize supply chains all at once. Solar, electronics, medical tech, grid infrastructure, components most people don't think about until they're missing. Silver runs through all of it. And when utility collides with fear, and fear collides with monetary stress, silver stops acting like a sleepy commodity and starts behaving like something people suddenly can live without. Now here, S, where the narrative shifts from silver is up to this could snowball. Once mainstream financial outlets start openly talking about silver outperforming everything else, you get a feedback loop. Retail notices. Commentators amplify it. Shorts grow uneasy. The market turns into a stage. You've probably noticed the chatter increasing, especially from voices that usually ignore metals altogether. People who only talk about tech stocks or crypto are suddenly asking, silver is up? How much? Attention is fuel. You can even see it in relative strength. The ratio between silver and one major crypto asset has been sliding, meaning fewer ounces of silver are needed to buy that asset than before. Translation? Silver has been gaining ground. Does that mean everyone is abandoning crypto? No. But does it suggest some speculative capital is rotating into a fast-moving, headline-friendly metal that still looks small compared to gold? Absolutely. And here's the uncomfortable thought. The move to 100 might end up being the least interesting part of this story. The real shift happens after people accept 100 as normal. Right now, we're in the squeeze zone, the part of the chart where everyone is staring at a round number, and round numbers do strange things to human psychology. They act like magnets, and they create traps. So let's talk about traps. The first trap, for buyers, is assuming that because silver moved fast, it must snap back immediately. That's not how parabolic moves always end. Sometimes they end with sharp pullbacks, sometimes with long, boring consolidation, and sometimes, this is the one people underestimate, they end with another leg higher because the market refuses to give you a dip. The second trap, for sellers, is assuming that because silver is high, it can't go higher. That mindset is how people sell too early and watch price walk away without them. So what signal matters most? Whether price can hold while physical premiums stay elevated. If international premiums persist, availability tightens, and price consolidates instead of collapsing, that's not weakness. That's pressure building. And pressure creates the next move. Now let's talk about something that flew under the radar but matters a lot: the mint. One major government mint has effectively repriced silver collectibles in a way that shocked a lot of people. Proofs and special issues are now being listed at levels that imply pricing well north of $150 per ounce. Items that sat near $90 not long ago are suddenly closer to $160. Think about that. The metal didn't change, the designs didn't change, production costs didn't double overnight. What changed was expectation. When silver moves, pricing moves with it. And while collectible pricing isn't the same as bullion pricing, it's a window into mindset, into what institutions believe the market will tolerate when demand heats up. And when a major mint reprices aggressively, it becomes a headline. Headlines create urgency. Urgency pulls demand forward. People who plan to buy later buy now. People waiting for a dip stop waiting. Fence sitters jump. That's how you go from silver is up to silver is gone. Now layer in dealer behavior. One of the largest online bullion dealers has reportedly introduced minimum order thresholds, meaning small, casual purchases are no longer frictionless. They're citing high demand, production lag, and shipping delays. This isn't about liking or disliking a dealer. It's about what the behavior signals. When sellers add friction, they're managing flow. They're controlling inventory. They're trying to avoid chaos. And those changes usually happen before the public realizes something is tightening. Now here's the cliffhanger. You might be thinking, okay, prices are up, mints are repricing, dealers are tightening, so what? Here's the so what. There is growing discussion around policy frameworks that could introduce minimum pricing behavior for processed critical minerals and their derivatives. Translated carefully, price floors. A price floor is another way of saying, this is too important to be cheap. And silver is increasingly being discussed as a strategic input. Am I saying a formal minimum price is announced tomorrow? No. But language matters. When language changes, policy often follows. And when policy follows, markets reprice. If you've wondered whether we're entering a metals war, the answer is that we ray already in the early stages of a supply chain war, one where governments and corporations race to secure inputs before someone else does. So let's pause for a moment. Hype is dangerous. Excitement clouds judgment. Clarity matters. Here's the framework. Short term. The market is obsessed with 100. That obsession can create a spike above it, or a stall just below it while pressure builds. Medium term. A gold to silver ratio below 50 changes narratives. It invites a serious question. Is silver finally catching up? Long term. If strategic language, industrial demand, and constrained physical supply continue to collide, today's prices may look cheap in hindsight. Which brings us to a sentence worth sitting with. Silver may never be this cheap again. Not because of drama, but because once certain thresholds are crossed, the brain resets. 95 becomes normal. 80 feels like a gift. And many people won't get 80. They'll get 110 after a scarcity headline. And scarcity headlines don't start with "we ran out." They start with shipping delays, minimum orders, higher premiums, longer lead times, temporary out-of-stock notices. Then allocation, limits per customer, back orders. Only later do the headlines catch up. I'm not here to tell you to panic. I'm here to show you how the machine works. So here's the final question to think about. Does the next major move come from investors chasing price, or from industrial buyers quietly removing supply before anyone notices? Because if it's industrial, the market can look calm right up until it isn't. Now let's go deeper into the mainstream narrative, because this is where people either understand what's happening or get played. When silver starts making moves like this, the media response almost always splits into two camps. The first is celebratory. Breakout headlines, new highs, momentum talk, technical patterns everywhere. Analysts come on and draw giant rounded bases, calling it a multi-decade structure finally breaking free. The second is dismissive. It's speculative. It's overheated. It'll reverse. Just another temporary spike. And here's the uncomfortable truth. Both narratives can be used against you. Celebratory coverage pulls late buyers in right near emotional peaks. Dismissive coverage shakes early participants out before the real move unfolds. So the goal isn't to pick a side emotionally. The goal is to anchor to signals. Signal number one is the ratio. We've already covered it. Below 50 matters. That's not noise. Signal number two is physical premiums and international spreads. If overseas pricing stays elevated relative to Western benchmarks, that tells you demand isn't theoretical. It's real. Signal number 3 is institutional behavior. When mints reprice aggressively and dealers quietly introduce operational restrictions, those are indirect tells. Signal number 4 is the tone of policy language. When strategic mineral discussions start drifting toward price support concepts, you're no longer in a normal commodity market. Now, let's address some of the most practical questions people ask during moments like this. One of the most common is, if silver goes above 100, do premiums finally calm down because spot is higher? Not necessarily. In fact, they can get worse. When spot rises quickly, inventory priced under old assumptions disappears first. Sellers then reprice based on replacement cost, not what prices used to be. They don't care what silver cost last month. They care what it costs to restock today. If production lead times are stretched, premiums can stay tight even as spot climbs. Another question that keeps coming up is whether this move is real or just paper games. There are always derivatives. There are always large players. That never changes. But sustained moves usually survive because the physical side tightens. When physical supply tightens, paper eventually has to respect it. This is also where it's important to zoom out. You do not need to time the absolute top to make sound decisions. Long-term positioning isn't about perfection. It's about consistency, discipline, and avoiding emotional trades. What works for one person may be completely wrong for another. This isn't a competition, it's personal risk management. Now back to the market itself. Silver near 95 feels tense, and that tension matters. You can feel the hesitation between I want to buy and I'm afraid to buy. That friction is what creates volatility, and volatility is what creates both opportunity and mistakes. So here's a practical framework for the days ahead. First, watch how price behaves near 100. A violent rejection can scare participants and trigger pullbacks. A slow grind higher with holding action can catch people off guard. Second, watch dealer behavior. More out-of-stock notices and longer shipping times tell you demand is outrunning logistics. Third, watch the narrative. When silver becomes a daily trending topic across platforms, that's a signal that new money is entering the conversation. Now let's add nuance to the idea of government price floors, because it's often misunderstood. A price floor doesn't always mean a posted number on a screen. Sometimes it shows up as subsidies, sometimes as guaranteed contracts, sometimes as procurement policies that quietly create a persistent bid in the market. And what happens when a persistent bid exists for a strategic material? Less metal makes it back into the open market. Supply tightens. That's why the phrase critical minerals matters. And here's the deeper implication. If silver starts being treated more like a strategic input than a simple commodity, traditional valuation models begin to fail. People will keep asking what silver is worth, and the market will answer with something simpler. Whatever price clears physical supply. That shift doesn't happen overnight. But the direction of thinking is changing. Which brings us back to mint repricing, because this story spreads faster than most people expect. When people see government-issued silver products priced at implied levels north of 150 per ounce, it creates a mental shortcut. It doesn't matter whether that price is rational. What matters is perception. It normalizes the idea that high premiums are acceptable. Once that mindset sets in, it's very hard to reverse. Now let's address the elephant in the room. Is manipulation involved? Large markets always have incentives, and incentives shape behavior. Some players benefit from suppressing prices. That's not controversial. But physical reality eventually overrides incentives. When supply tightens and demand persists, price rises. That's why physical signals matter more than theories. Now we need to talk about the latecomer wave, because this is where virality forms. The latecomer wave begins when people who never cared about silver start asking how to buy it, coins or bars, all at once or over time. Did they miss it? Those questions feed algorithms. Algorithms amplify content. Content draws more attention. That loop accelerates fast. If you're new, the key is not to rush. Learn the landscape. Build a plan. And if you've been around for years, understand that helping new participants strengthens the entire market ecosystem. Now let's look ahead. If silver touches 100, you will see extreme projections everywhere. Some will be entertainment, some will be fantasy. A small fraction will be thoughtful. The path matters more than the number. A move from 95 to 105 can happen quickly. A move from 105 to 150 requires sustained conditions. Anything beyond that requires a full regime shift. So what conditions would support continuation? Sustained international premiums, ongoing inventory tightness, continued ratio compression, policy tailwinds, a broader commodity bid as currencies weaken. Now add one factor people underestimate: regret. When silver breaks a major level, people who didn't buy feel regret. Regret turns into impulsive buying. Impulsive buying creates spikes. Spikes create stories. Stories generate more regret. That loop is what drives parabolic behavior. What breaks the loop? Supply returning, fear disappearing, or attention shifting elsewhere. Right now, supply isn't returning quickly. Fear hasn't evaporated. And attention hasn't fully shifted. That's why this doesn't look like a normal move. Now, let's be practical. Buying today may involve higher premiums, limited selection, or longer delivery times. That's not a moral issue. It's a market reality. Compare sources. Look at total cost, not just spot. Understand your own tolerance for volatility. And don't let fear of missing out make decisions for you. Here's a simple scenario map. Scenario 1. Silver tags 100, wicks higher, then pulls back into the low 90s. That shakes weak hands and offers a second chance. Scenario 2. Silver tags 100 and holds near the upper 90s. That's consolidation, not weakness. Scenario 3. Silver spikes above 100, races toward 110 or 115, followed by sharp volatility. Scenario 4. An external shock hits and silver gaps higher with no clean entry. Which plays out depends on headlines and positioning. But across all scenarios, the macro backdrop remains supportive. Zooming out even further, the world is restructuring supply chains. Governments and corporations are racing to secure inputs. Silver sits at the crossroads of energy transition, electronics, and defense. It may look like just a coin to the public. It does not look that way to policymakers. That's why language matters. That's why procurement matters. That's why this market is changing. So the final question isn't just whether silver hits 100. It's what kind of market exists after that level is no longer shocking. Because if silver settles into a world where triple-digit pricing is normal, premiums stay elevated, and inventory is rationed, the people waiting for cheap silver may find that window already closed. Not because of hype, but because of transition. And right now, that transition is underway. Now here's the final cliffhanger. If the market pushes through 100 and holds, something predictable but powerful happens. People who never cared about silver suddenly can't stop talking about it. That obsession becomes fuel. Attention turns into momentum, and momentum turns into the next leg higher. But if the market rejects 100 and drops hard, the headlines will flip instantly. Bubble popped. Speculation over, silver crash. And that panic could be the exact shakeout that clears the deck for a much larger move. Either way, the story does not end at 100. That level is not a finish line. It's a doorway. So here's how to think about it. The questions that actually matter aren't emotional ones. They're structural. Are current ratios forcing reallocations? Is physical demand staying firm under pressure? Is industry quietly locking in supply while the public argues about charts? Those answers shape what comes next. And before we wrap this, there's one angle that almost never gets enough airtime, but it matters a lot. Whenever silver moves like this, the same question surfaces immediately. Do you buy mining stocks or do you buy the metal itself? Here's the reality. Stripped down, paper moves fast, and paper can reverse just as fast. Physical moves slower, but physical is what the real world fights over when supply tightens. If you've watched enough cycles, you already know the pattern. First come the headlines, then comes the rush into paper exposure, then quietly comes the scramble for actual ounces, and only after that does the public realize something uncomfortable. There isn't that much silver to go around, because silver isn't just something people collect. It's an input. It goes into electronics, energy systems, medical applications, industrial processes. Things you don't just substitute overnight because the price chart looks stretched. If the world keeps pushing toward more electrification, more infrastructure, more technology layered on top of everything else, demand doesn't politely step aside just because prices moved fast. Which brings us to what really matters next. Watch the premiums. Watch delivery stress. Watch how quickly retail inventory disappears when price accelerates. And watch the ratio. If the gold to silver ratio stays under 50 and refuses to bounce, that's not background noise. That's the market telling you silver is no longer a sideshow. It's stepping into the main narrative. And before we end, let's ground this in something human. If this move has changed anything for you, maybe you finally started building a position, maybe you reduced debt, maybe you took your first step into hard assets. Pause and recognize that. Progress doesn't have to be dramatic to be real. Markets like this don't just test capital, they test patience, they test discipline, they test whether people can stay rational while everything around them gets louder. And that's why this phase matters more than the headlines. Because if silver does smash through 100, the celebration will be short-lived. What follows after the cheering fades is where the real game begins. And that's the part worth watching.